Markets are prepared for a turbulent year ahead due to inflation, energy shortages, and general instability. Hey, it's the Coin Fixer. Today we'll be looking at the different reasons why 2023 looks like it may be a tough year for global markets and what you can expect coming into the new year. Before I begin, let me say that I am not a financial advisor and this is not financial advice. Do hit the like button if you get some value out of this video and do subscribe for more crypto related content. Alright, let's continue. People who bring warnings are rarely welcome. When Cassandra warned her fellow Trojans to avoid the Greeks and their wooden horse, she did herself no favors. But it's crucial to look closely at economic realities given the unprecedented turbulence that the financial markets are currently experiencing. Analysts concur that markets face significant challenges. According to IMF predictions, the global economy will be in a recession for 1/3 of 2023. Prices are high and rising. There is a high demand for energy, and emerging economies are emerging from the pandemic in uncertain circumstances. Given that there are no clear options for investors in uncertain environments, there are 5 fundamental problems that will affect asset markets in 2023. These problems are interconnected and pose a threat to their stability. Trade-offs are necessary for all decisions. Net energy shortages. Without significant changes to the geopolitical and economic environment, it appears that fossil fuel shortages will continue through the upcoming winter. Due to sanctions resulting in the conflict in Ukraine, Russian supplies have been drastically reduced, and a blast that destroyed a portion of the Nord Stream 1 pipeline has irreparably damaged Europe's energy infrastructure. Because building new infrastructure requires time and money, and because ESG regulations make it difficult for energy companies to defend significant fossil fuel projects, the situation is irreparable. Meanwhile, once China recovers from its COVID-19 slowdown, the already robust demand will only grow. Electric vehicles and renewable energy have seen record growth, yet there are boundaries. Hard-to-find materials like lithium, cobalt, chromium, and aluminum are needed for renewable energy sources. Nuclear power would relieve the strain, but new plants take years to come online, and public support can be challenging. Supply chain shocks from the pandemic and Russia's invasion of Ukraine have triggered an appetite in major economies to reshore production. While this could prove a long-term boon to domestic growth, reshoring takes investment, time, and availability of skilled labor. In the short to medium term, the reshoring of jobs from low-cost offshore locations will feed inflation in high-income countries as it pushes up wages for skilled workers and cuts corporate profit margins. Transition to commodities-driven economies. The same disruption that sparked the trend towards reshoring have prompted nations to look for safer, more environmentally friendly raw material supply chains, either within their own borders or those of allies. Recently, the extraction of vital rare earth has been outsourced to nations with cheap labor markets and lax tax laws. The sourcing of raw materials will need to be rethought as these processes move to jurisdictions with high taxes and high wages. This will increase investments in exploration in some nations. It may lead to challenging trade alliances for those unable to obtain commodities locally. Such alliances should reflect the geopolitical transition from a unipolar to a multipolar world order. For example, many nations in the Asia-Pacific region will start prioritizing China's agenda over that of the United States, which will have an impact on American access to commodities that are currently sourced from Asia. Persistent inflation. Inflation is unlikely to slow down anytime soon given these pressures. This presents a significant challenge for central banks and their preferred method of price control, interest rates. Now that we have entered a period of secular inflation with supply-demand imbalances brought on by the dissolution of globalization, higher borrowing costs will have little impact. In the past, inflationary cycles have ended when prices reached an unaffordable level, causing a decline in demand. When it comes to discretionary purchases, this process is simple, but it becomes challenging when purchasing necessities like food and energy. There is little room to relieve upward pressure because businesses and consumers are forced to pay the higher prices, especially since many governments subsidize consumer purchases of these essentials. Accelerating decentralization of key institutions and systems. Two elements are driving this fundamental change. First, conflict, tight monetary policy, and broken supply chains caused a realignment in geopolitical world order. Second, a general decline in trust in institutions as a result of a disorganized response to COVID-19, poor economic conditions, and widespread misinformation. The first point is crucial. Nations that once looked to the United States as a voice of reason and upholder of order are now doubting this alignment and attempting to fill the void with regional ties. Additionally, it has sparked an increase in interest in alternative service access methods. During the pandemic, homeschooling increased. Then there's Web3, developed as a rival to conventional systems. Consider the efforts made in the Bitcoin community to connect customers with regional ranchers through the Beef Initiative. Waves of decentralization have historically followed periods of extreme centralization. Consider the fall of the Roman Empire into small fiefdoms. The simultaneous revolutions of the 18th and early 19th centuries, and the development of antitrust laws in the 20th century in the West all witnessed the disintegration of massive structures into their component parts. The gradual centralization process then started over again. Revolutionary technologies are accelerating today's transition. While not novel, the process is disruptive for both markets and society. After all, markets depend heavily on being able to predict outcomes. This is getting harder and harder to do as the fundamentals of consumer behavior change. When considered collectively, all these trends indicate a time when only the cautious and savvy investor will prosper, so buckle up and get comfortable for the ride. That's all for today's video. Let me know your thoughts in the comments down below, and if you liked the video and it brought you any value, do hit the like and subscribe button. Thanks for watching. Till next time.